and we're here today speaking with Neil George about high yield the safe way. Neil, welcome.
Thanks very much. Glad to be here.
So, Neil, you told me that you have some interesting strategies for generating high yield the safe way. Tell us about that.
Nick, I think the key thing to look at is that so many investors have been taught over and over again to avoid what we're told is the high risk markets. And by high risk, I mean countries that are supposedly emerging. These are countries like Brazil, Thailand, Indonesia, China, and so forth. Countries that have that moniker of emerging market has been, Wall Street's always told us, as being sort of the high risk. And yet, what we've learned, particularly over the last couple of years, are that the countries that are supposedly the riskless, the United States, Great Britain, Ireland, the rest of the European Union, Japan, these are the countries that supposedly were the riskless. They're the ones that are wanting, for selling their bonds, trying to raise credit, and as a result, the countries that actually are perceived to be the risk, they're the ones with all the money. They're the ones with all the trade flows. They're the ones with the massive reserves. And they're the countries that these countries like the US, Britain, other parts of Europe are actually going begging for money. And so the idea of looking at some of these countries as a mechanism for getting paid with a lot more real certainty and oftentimes getting a lot more high yield, that's where I think a lot of investors can be safer by actually investing in what's perceived as being higher risk.
Do you have any specific investment recommendations in this regard, Neil?
Well, I think, Nick, what you look at is if you try to look to buy, let's say, a treasury bond of Brazil, it's not necessarily going to be an easy task for an individual investor, regardless of whether you're in the UK, US, or wherever. Trying to buy a Chinese government bond is, again, not going to be an easy task. Same thing if you look at a lot of these high-yield marketplaces. But there are some nice funds that are out there, both in the US and the UK, that gives the individual investor the ability to get these exact same bonds in an efficient manner and get paid a very high dividend yield. Now in the US, one of my favorites for a long time that I've been writing about and following, and I also own myself, is run by the AllianceBernstein fund organization called the AllianceBernstein Global High Yield Fund. Trades on the New York Stock Exchange, the symbol AWF. Pays a dividend yield about 8 to 9%. It has an average annual return for the past decade and roughly about 12 to 13% per year, investing in these exact same markets, Brazil, China, Indonesia, Thailand, etc. In other words, generating high cash flow and paying it out to the investor. In the UK, for investors that, that want to focus on markets that are trade on the listed market in the London Stock Exchange, you have one which is actually tracks the JP Morgan Emerging Market Fund. And this basically is the iShares 2 fund. IEMB on the London Stock Exchange. Again, similar performance to AllianceBernstein. It's done a little bit differently, primarily for the British and European investor. But again, a dividend yield which is roughly around that 6 to 7% range, and an average annual return in those low teens since it came to the market a few years ago. Those would be some of the ways in which you can get paid high yields, get the appreciation by cashing in on the real credibility that's being built by these emerging markets, and at the same time, provide a currency offset from a sagging dollar or potentially a further sag in the British pound.
That's interesting. What kind of volatility do these funds have?
Well, that's the interesting thing about this, is that if you look at the funds and you look at the underlying assets, they tend to be fairly low volatility as far as the assets, but they're traded like stocks, and therefore you will get some of those up and down movements. That gives an opportunity for investors that get to know these funds. In other words, when the stock market, whether it's happening in New York or London or elsewhere, starts to have some dramatic days, which happen periodically, some of these funds will actually trade as if they're part of the general stock market. And therefore, that provides some great bargain opportunity. So if you start to buy into some of these funds, get to know them, get to know how the holdings are, and get used to these monthly and quarterly high dividends that come off these funds, on down days in the stock market, it gives you an opportunity to step in and buy more or reinvest at some fairly attractive rates.